In this video, what we are going to do is learn 4 Excel formulas that will allow you to make smarter decisions when it comes to portfolio growth. Okay, what you see on my screen is a simple Google spreadsheet, and we are going to automate everything and you're gonna love it. Okay, so what you see on my screen is first column where we have got listed all our stocks and mutual funds. For simplicity, I have considered 5 examples of stocks. These are not stock recommendations. This is not my portfolio, but simply I've put few names so that I can show you the automation that we are going to do now. Also, I've taken 2 examples of mutual funds. Again, I've created separate videos on both these mutual funds. You go and watch why I like these 2 mutual funds. Let us now go ahead and say, I need only 3 information from you. Okay. As long as you can provide me this 3 information to this sheet, everything then will get automatically calculated and we're going to make some smarter decisions more importantly, right? So let us say Infosys. We say that you have bought 10 shares of Infosys. Okay. And you invested, I don't know, 10,000 rupees, for example. Let's put that number in here. And let us say that you did the investment on 15th of January, 2022. All right. The first formula we are going to learn is to find out the current value of any stock or mutual fund. Okay. It's a very simple thing. What we're going to do is the formula is Google Finance. Okay. So we are going to type Google Finance. Now you will notice what Google Finance need from in this formula is we need to go ahead and find the code of that stock or a mutual fund. And let me show you how easily we can go and find it, right? So we are going to go to Google Finance. You will see like this. Let us click on Infosys. The moment you search for Infosys, on the top here, you will get the code of Infosys, right? We need to copy that. So let us Control C this from here and bring it here. Now let us put double quotes here, and in between these double quotes, we are going to insert this code here, okay? So we need to get this space as well in between because the formula otherwise is not going to work. Very, very important. We are now going to close the bracket here and press enter. What this has done is that it has brought us the live stock price of Infosys. Anytime you open this sheet, it will automatically go and get connected to Google Finance, and it is going to bring that day's stock value. So we don't need to go and look around for what is the current value today, what is the value tomorrow. This Google Sheet is going to automate everything for you, right? So let us say now the current price is 1522. So that means in today's date, my investment is this into the number of units I bought, 10 units I bought. So it is 15,215 rupees. Current date. We also want every time the current date to get automatically populated. For that, we are going to use a simple formula that is called today's date. Okay, so we are going to enter today's date. It is giving me 17th of December when I'm shooting this video, right? Now, importantly, we need years of investment. How long I have kept this investment for? Again, very simple. What we are going to do is current date minus, we are going to look at the investment date. We are going to put brackets. Brackets are really, really important, as you already know. And we are going to calculate it in number of years. So I'm going to divide it by 365. Okay. Now it is not, some years will have 366 and all that. That complication I'm not building. I think we are okay with that, right? So it means I invested in Infosys in January 2022, and in 17th of December, I am getting my investment value, and my year of investment is 0.92 years, right? Now we are moving to our second formula, which is called compounded annual growth rate. It is absolutely important for us to understand how to calculate CAGR. Why? 2 reasons, and then I will explain how to calculate it. The 2 reasons are, number 1 is we need to know out of our portfolio at any point in time, what is the compounded annual growth rate, even if a stock or mutual fund has not completed 1 year or has completed multiple years, right? It's very important for us to compare our stocks and mutual funds or any other asset to make sure we understand how much of compounded annual growth rate we are getting, and is it in line with our portfolio or not. That we will talk later, right? The second thing is, if you know, every mutual fund will display their returns in compounded annual growth rates. So if you want to compare how my portfolio is doing right now with other, let us say Nifty 50 index or Sensex index or a thematic mutual fund or a large cap, small cap mutual fund, you will need the CAGR calculation, right? So simple formula for CAGR you will never forget. Okay. Simple is RRI. Very, very simple formula, RRI. Remember it, and you only need 3 things for it to calculate. So one is number of periods. So period is, in this case, is 0.92 years, comma, what is the present value, and then what is the future value. So in this case, we are calculating CAGR. So future value is this value here, and the current value is, sorry, so we need to take the present value first. So present value is this value here, what is our investment amount, and our future value is, it has become 15,000 here. We are going to close the bracket and we are getting a CAGR of 57.76%. Although this stock has not completed 1 year, but if it carries on growing like this, we are going to get 57.76% as an annual growth rate on this, right? So what we are going to do is, I'm not going to calculate all these rows, but what I'm going to do is I am just going to copy paste it here, just so that we can get some meaningful numbers. But I do want to show you how to do it for a mutual fund as well, right? So let us say Axis Small Cap Mutual Fund. What we are going to do is, we need the current value first, right? Using the Google Finance formula, we're going to go back here and we are going to type Axis Small Cap Mutual Fund, and you will see the first one. Always remember to invest in direct funds because you can do your own research and they are really cheap, right? So I've created a separate video on that topic as well. Please go ahead and watch it afterwards, right? Okay, we're going to copy this code as I explained in the formula, and we are going to again apply Google Finance here. We are going to put the double quotes. In between the double quotes, we are going to put the code in here, and then we are going to get rid of this space from here, and then we are going to close the bracket and we are going to get the Axis Small Cap's current NAV. Okay, now let us make it a little more complicated. Let us say 15th Jan of 2020 here rather than 22. I want to make sure that you can see how it calculates for multiple years. And let us say that you bought, let us say you bought 100 units, right? So your current investment will become this. So your value becomes 7,250. Let us say in 2 years back, you invested 3,000 rupees on this fund. Okay. Now all I can do is simply just put it down. And what you will see is this you have got 2.92 years investment. All right. And you've got a CAGR of 35.24%, right? Now this now tells you how your portfolio is growing. You can compare your stocks, and this is very, very important for you to compare your own stocks. And also you can compare it with other investment asset classes that will give you a good view of how your portfolio is performing versus external factors, right? Let us now learn formula number 3, which is the future value. Very, very important. What we really want to know is, if our portfolio carry on growing at the rate that we have calculated here, what is likely to be the portfolio value after, let us say, 5 years or 10 years or 15 years, whatever is your planning horizon. That is what we want to know. Okay. So we are going to use a formula called future value. So we are going to take the rate here. Let us assume that it will grow at the same rate. It may not. And we are talking about, let us say, 10 years of horizon. You can enter whatever is your horizon here. And now payment amount is what will be the future value. So we are just going to leave it as optional now. And present value is your total investment right now that you have. And then beginning or end. It's very simple. We are going to put 1 here because we are putting this money right now into the bucket, right? So if you just do that, okay. Also, please make sure you put a minus symbol here in front of it. Okay. Now this is the value we are going to get after 10 years, right? We are going to simply copy it down here. And now we know that our portfolio after 10 years will give us this much value. So let us go ahead and put a sum of this here, which is excellent. So by next 10 years, we will have a portfolio of, in this example, 88 lakh rupees, right? Now, what we are going to do is we are going to move to formula number 4, understanding what is that we need now going forward. Okay. So let us say my projected amount after 10 years is 88 lakhs. So I'm just going to copy it here. But let us say my financial plan says that after 10 years, I would like my wealth to be, let us say, 1 crore rupees, right? So I'm going to enter what is my target amount here. So 100,000, 10,000, lakh, 10 lakh and 1 crore rupees here. All right. Now, what is the gap between what I want to have versus what I am likely to have? So if I just deduct this, I'm going to get 11 lakh rupees, 32,000 rupees is the gap in terms of the current position. And again, it is a projected flow, right? Now, let us say we are talking about investment horizon of 10 years, right? The key question I need to ask right now is, what is going to be my monthly investment right now? If I start to do additional monthly investment right now, what will that amount be that will fill this gap? Okay, that is the key question we need to answer, right? So what we are going to do is we need to make an assumption on our compounded annual growth rate for the next 10 years, right? Now, what I would suggest right now, we don't know what it will be, but what we can do is take an average of this compounded annual growth rate that we have been able to generate in our portfolio. So if we just copy this, we are going to get an average of 54%. Again, 54%, and these numbers are really high because I've just made up these numbers, but I'm sure it might be 10%, 15% depending on your portfolio, right? So take an average of that here using this formula, and what we are going to do is get it here. So we have got this one here, okay? Now we need to calculate, if I assume that my portfolio will continue grow at this rate, how much of monthly SIP I should start doing, okay? Very simple. We are going to use a formula called PMT, and the way it works is we will take the rate, which is 55% here, but remember we are calculating it for monthly, so we have to divide it by 12 because the PMT formula in general will work for yearly installments, right? But we are calculating monthly, so we divide it by 12. The number of periods is 10 years, but again we are needing to multiply it by 12 because every month we are investing here rather than a year. So we have multiplied it by 12. The present value we don't know, right? So we only know the future value that we want to really get to. So we are going to put the gap in here. And then we have this money right now. If we start doing at the beginning of this period now, tomorrow if I make an investment, what will that amount be, right? And also let us make sure we put a minus symbol before the formula and calculate it. So it gives me 239 rupees, meaning for me to fill this gap of 11 lakh rupees, if I start doing monthly SIP of 239 rupees right now, and if my portfolio continues to grow at an average rate of 55%, then I'm going to make sure that in the next 10 years, I will have 1 crore rupees, right? How powerful is this? This planning we all must do, right? Because what will this planning do is it will allow us to save more because we need to start investing more because we know we might not hit our target, right? This is the level of thinking and planning we need to do. What about if you want to use the yearly formula? So all I would say is simply use the PMT formula for yearly basis. If you want to go for yearly investment, number of period and the gap will be here. We are just simply, I've removed the 12 factor here and it will be gap here 1 and then bracket close. Again, I keep forgetting about putting the minus symbol in front, and there you go. So it means every year I have to start doing investment of 5,200 rupees for me to be able to hit my target gap of 11 lakh rupees. So in summary, we have learned 4 formula that I've captured in this sheet. If you need this sheet, please drop in the comments. So summarizing now, current value formula, which is using the Google Finance, going and finding the code, it will give you the current value. It will always keep your Google Sheet up to date. Okay. The next formula is CAGR, very important. We have used a simple formula of RRI. Okay. Using that, we can calculate the CAGR even if your investment is less than 1 year, which is very important. Then the third one is the future value, wherein we are calculating if we continue to grow at this rate, what will be my future value? What will my investment will become 10 years down the line, 5 years down the line? You can change the number 10 to 5, 8 depending on your planning assumption. Okay. The next formula we have learned is if that is what our portfolio is likely to be, then how much of a gap I'm going to have depending on my financial plan or a goal. Therefore, how much of monthly installments I should start doing right away. I hope you enjoyed this. I hope you found a lot of value in it. If you did, please like this video. Let me know in comments any formulas that you use and might be useful for this community. I'll be more than happy to create more videos if you have any questions. Keep rocking.